Hello, everyone. This is your host, Accel Jabbar, and welcome back to another episode of SaaS District. In today's episode, we'll be talking about exploring investing trends and fundraising going into 2024. Today, we have our guest, Michael Treskow, joining us. Michael is a partner at 8 Roads Ventures, based out of London, UK, where they're focused on venture and growth investments in technology companies across Europe and Israel. Previously, Michael invested in tech companies at Accel in London and Warburg Pincus, both in San Francisco and New York. He received a bachelor from Yale University and an MBA from Stanford as well, School of Business. So welcome, Michael. Super excited to have you on the show today.
Thank you for having me, Accel. How are you?
I'm doing great. Thank you. So just before we get in, we'd love a little bit more background on, what stage you guys are investing, right? So I understand you're in venture growth investment. Just to give background for people listening in, looking to have an idea of where you invest, what does kind of your investment thesis look like right now?
Yeah, look, so I think a little bit about 8 Roads, right? So we started about 50 years ago in Boston, back then called Fidelity Ventures, and have since then expanded internationally and become an independent company, 8 Roads. So I'm part of our London team focused on Europe and Israel, as you said, and then I have colleagues in India, Japan, China, and the US. So a pretty global perspective. And the core focus really is on supporting startups that have found product market fit, right? So I think, there's a lot of talk about going from 0 to 1, and we focus on the journey from 1 to 100, right? So you've built a product, you've found customers who like the product and derive value, and now it's all about scaling. So that's where we come in. And typically when we partner with startups, they're generating revenue, they have paying customers, and it's probably somewhere between a Series A and a Series B.
Okay. And what are you guys leading the round? What is your typical check size, just for context?
Yeah. So we'll typically invest somewhere between 10 to 25 million initially, and then continue supporting the company as they raise more capital. We don't really care whether we lead the round or not. It ends up being the case most often just simply because of the round dynamics. So you will raise 30, 40, 50 million. Insiders want to participate in the round, and there ends up typically being space left for one lead.
Got it. So it's an interesting space you guys are in. It's between Series A and B. What we're seeing in the market is, that's kind of been a situation where in the market there's just been less funding available. It's been more challenging as what we've seen for founders to get financing or raising. I'm curious to see what you guys are seeing, because it seems like they're struggling to get their Series B or above round, or even exit. So that stage is where we're seeing a bit of issue. So what's been kind of your biggest filter, whether that's growth or other, that's helping you differentiate, just for people listening in to help stand out and understand how to pitch you guys, etc.
Yeah, look, I think that's a good question, right? So essentially at the stage where we invest, right? And let's say it's a Series B, just for clarity, right? At that point, we're really looking for proof points of product market fit and scalable execution, right? So we're past the point where it's a great idea. We're, past the point of initial traction. And essentially, it's not as easy to hide anymore, right? Mm-hmm. And conversely, of course, then when companies are doing well, it's much more clear that they're doing well, right? Like at earlier stages, it's a bit tougher to tell sometimes which one is the stronger company or opportunity. By the time it gets to Series B, it's much more clear, right? There are proof points, there are track records. You can speak to customers, you have sales metrics that you evaluate, and so on and so forth, right? And so I think that means that if you have a company that's doing well, it's going to be as easy, I think, to raise funding today as it was before, right? I think the tricky part is that certainly during COVID, there was a bit more leniency at this stage. And there was a bit more open-mindedness in saying, let's go do the Series B a little bit earlier. Let's extrapolate a little bit more. And I think some of that has gone away, right? So I would say, for the most part, we're probably back to where we were pre-COVID, right? Mm-hmm. As far as the bar. And clearly that now feels much higher than it was during COVID. But actually, relatively speaking, if you were investing before COVID, not much has changed, I would say.
Yeah, that makes sense. So, obviously this seems like a challenging time for both investors and startups, but like you said, it's just kind of regulating back to what it was pre-COVID time. But for those who are maybe struggling, they're kind of running out of runway, they're in between that, Series A or looking to raise a Series A or B, what are some tips or strategies you can help, suggest to them to help them overcome some of these hurdles right now in the market, if any? Mm-hmm.
Look, it's always a tough one just because it's such a generic one. I mean, I would probably say fundamentally, I would probably bucket companies into three, right? There's one bucket that's doing really well, right? And they're receiving the signal from the markets, and they're going to go out and they're going to raise a great round, right? And then there are companies that are clearly not doing well, right? And they have some tough decisions to make. The main question there is, can you get to profitability, and do you want to, right? So I think one should consider it's an investment of time and opportunity cost. At some point, what are the most attractive options, right? Is it to get to profitability? Or is it perhaps to say, look, it just wasn't meant to be, and let me go start something new, right? And then the toughest ones are the ones in the middle, where it's going kind of well, but people are not lining up. But it's going well enough where, maybe you do want to continue investing in growth, and maybe, profitability at all costs may not be the right solution, right? And that's probably where it's very context dependent, right? And that's where I think the board is really the most impactful, right? And that's also where, some honest conversation, some honest feedback is most useful, right? If you can get some investors to give you some concrete milestones and things they're looking for, then you can focus on those. But I think as always, it's a trade-off. There is, getting the next venture round is not, the greatest accomplishment in the world for an entrepreneur, right? It may not be the right thing to do. And, I think fundamentally in the long run, all of these companies need to figure out a way to become profitable, right? Mm-hmm. It's just that for some of them, it will have to be sooner rather than later.
Yeah, that's interesting. Yeah, that middle bucket is kind of also where we're seeing most of our opportunities come in. There's a lot of good, businesses right now out there where they're kind of in between. They're like, do we go profitable? Do we raise? They're kind of in between trying to decide. And it's not clear that, from the markets and going out, they're not getting clear signal that they can raise at a round where, their investors are happy at considering the previous round, but then now they're like, but they still have a good company, numbers looking good, but unfortunately they just don't have the capital to continue scaling. So it's interesting. Yep. Yeah. What are you kind of excited about, or what are you kind of looking for going into kind of 2024? Is there any certain industries you guys are really focusing on? Is there certain verticals you guys really like? And especially with, considering the emergence of AI into this year, how are you guys looking at all of that and thinking about SaaS in general?
Yeah. So we are generalist, right? So I would say probably SaaS or B2B really, it's about 3/4 of what we do, right? And within that, or really anywhere in technology, AI has been having a very big impact, right? And so I would say we're, like everyone, excited about AI. I would say the one thing that is undoubtedly clear is that end customers will be benefiting greatly from all the innovation that's happening, right? I mean, you and I are already benefiting, right? Be it ChatGPT or be it some maybe generative videos that you might be creating on the side, and a whole host of other tools. And more of that magic is coming to the enterprise, right? And I think the real question for us probably is, aside from the infrastructure providers, be it AWS or NVIDIA, who's going to capture some of that value that is being generated, right? And, I think there's been plenty written about at this point about the various layers of the ecosystem. And I think the gist of it is it's too soon to tell, right? So I think we're trying to spend a lot of time meeting with founders and understanding how the landscape is evolving, right? And ultimately trying to make sure that we partner with companies and founders who look like they might be able to stand the test of time and build sustainable companies, right? And once you go beyond that, there's a ton of opportunities, right? I mean, software is still eating the world. There still continues to be a shift from offline to online, despite maybe, all of us thinking that it's been underway for a while. The shift to mobile is still continuing. So some of these big picture trends are going to be going on, but I think AI is enabling some of these innovations to become much more user-friendly and much more exciting and create this wow experience, right? That I think all of us have experienced when you type in a few lines and then ChatGPT gives you a quite sensible answer, right? Or goes back and forth with you, right? This magic moment. And I think that's going to be fundamentally, I think, changing how we engage with software.
Mm. Do you, we're seeing, some of the AI companies raising, capital at insane valuations right now. I guess some of the hype compared to some of the previous, new emerging trends. Are you guys also participating in some of these rounds that you're seeing? And are you seeing some of these, valuations at, sometimes 100x or whatnot, or even with very little revenue?
We're looking at all of them very closely. So far, we have not been the ones who are leading some of these rounds.
Yeah.
Mainly because we're not quite clear yet on how that market is going to evolve.
Yeah.
Right. And I think some of these are going to be phenomenal companies. And with some of these, as usual, we're going to be beating ourselves up that we didn't invest when we had the opportunity. Sure. And with others, it's going to be less. So, it remains to be seen. I mean, I think the most fascinating aspect of this new wave really is that in many instances, incumbents tend to benefit disproportionately rather than new entrants, right? So unlike some of the previous platform shifts, this is one where you look at the Adobes and Salesforces of this world. They're doing a pretty good job relatively quickly, right? Mm-hmm. And they may not be as quick as some of the new entrants into the space, but they have the distribution and customer trust advantage, and they are capitalizing on that, right? And so I think that's another aspect that makes this a little bit trickier to call, and you have to be a little bit more careful, but the opportunity is clearly there, right? These are gigantic markets, and 10 years from now, there are going to be companies that have been built up on this trend. They're going to be very successful. And of course, we want to be part of that.
Yeah, that makes sense. Considering the overall, startup ecosystem, there's been a lot of hype of folks that are trying to get into this space now, especially with AI. A lot of new companies are emerging, which is exciting. But then there's also, going up all the way to public markets. We're seeing, the valuations dropping, but also, less IPOs. How are you seeing that kind of top-down impact from all the way from public markets to startup fundraising? Where are you guys at down to the overall startup ecosystem, and what are some of the effects?
Yeah, well, and look, so I think we've had a bit of a roller coaster, right? So, we had a nice bull market. Then you had the COVID shock. And then the COVID shock turned actually into an unexpected gift, right? And exuberance followed now by another shock and stabilization, right? So I just used a lot of pretty extreme words to describe what happened within the span of about 36 months, right? So this sort of volatility, I think, is pretty difficult for a startup that is trying to lay out a multi-year strategy. Right. And is trying to make an assumption of the future based on historical patterns and these historical patterns are changing drastically every 6 months or 12 months, right? And so I think the good news is that we have, for the last year, seen a bit of a stabilization, right, in the public markets. And I think that's something that we're also seeing reflected in the underlying fundraising environment, right, for private companies. And I think, the rule of thumb is the more mature you are as a company and the closer you are to, the size of these public companies, the more it matters to you what is happening with these companies, right? So, to give you an example, you're a Series D or a Series E company and you're thinking about going public, and your public comparable company against which you might be measuring yourself goes up in value by 50% or goes down in value in 50%. You're paying very close attention to that because that translates very directly into how you might be assessed in that environment. So that's the one extreme. The other extreme is that you just started a company and you raised your seed round that is going to be completely disrupting that company that just went up and down 50% in value. But that disruption is going to take you about 10 years. How much do you care about the value of that company having gone up and down? Probably much less, right? Because most of the value of your company today is this option that you might achieve greatness, right? And your upside case and your downside case have a huge range of outcomes in between them, right? You might become that public company, or we may never hear from you again, right? And so, as an investor in a really early stage seed company, I'm less bothered by the valuations of this public company, right? Because I'm investing still at a relatively low valuation where if this company is successful, I'm going to do great, right? And I'm paying a lot of the value that I'm, when I'm thinking about the valuation is about, well, what would success look like in this upside case? If I'm the Series D or E company, the distance between upside and downside case is much smaller, right? Because there's years of track record. Things are not going to fall off the cliff, hopefully, but it's also not going to be a hockey stick from here on, right? From here on, it's much more predictable what the upside and downside looks like. And as a result, this option value has diminished much more in my valuation, and I'm focused much more on the public comps, right? And so to come back to your original question, what we have seen is that as the markets fell off the cliff, for lack of a better word, late stage funding has been significantly impacted, right? Because all of these companies raised a previous round that was tied to valuations that today are maybe half of what they were. And they really need to figure out a way to grow into those valuations, right? And for the most part, the difference has been so drastic that it will take them a little while to get there, even if they're doing well and everything is on plan. But, they just need to continue working. And this is not the time for them to raise if they have access to, capital otherwise, and, hopefully haven't spent the money that they raised. So that part of the market has been quiet. On the seed stage, not much has changed, right? Because, again, it's all about the idea and the founder and the option value that derives from those two. And public market is going to matter in 5-6 years. So I think it's fine. And then the other effect that you're seeing is that investors who are not seeing many opportunities in the Series A rounds, for example, are now going early stage because that market is still vibrant. So we actually have more capital now looking at seed stage opportunities. And so that market is still doing okay. And I think the question there is, how long will it take until they do see some of these situations emerge, and they'll see, well, some of these companies were able to raise a seed round, but maybe the Series A got trickier and then Series B got even more tricky, right? Because there is some dependency here, right? And I think we're kind of now in this digestive period where we're seeing some of these dynamics play out, right? Where the market for Series C, Series D has been awfully quiet. The seed market has been vibrant. But over time, these will converge because at some point, these seed companies will need to raise their A, B, C. And so the temperature among the seed investors is going to be impacted by the temperature among the Series A and Series B investors.
Yeah, that makes complete sense.
Long answer.
But no, I completely get it. So so 300 plus companies you guys invested in, $11 billion asset under management. So you guys have a lot of data of what works, what doesn't work. And now you're at a stage. So you're kind of at a better point than maybe folks, but you also have companies within your portfolio who are maybe now at later stage, right? They've gone on to raise Series B and C. So there's different options here. One is, you said go profitable. Two is, you shut down. Three is you try an IPO or continue to raise the next round, or you try to delay it, some kind of bridge round. Another option is also considering an exit. How many of maybe your companies, or what are you suggesting to folks, or what kind of companies would you suggest that as an option to who are listening in?
Oh, that's a good question. I mean, I think it's all a matter of comparing your alternatives, right? I mean, I think there are situations where an exit, it's about time, right?
Yeah, I'm trying to think when there's like a clear time, right? Where it's like, this is probably just makes the right, like comparing all the options, this just seems to be the,
I mean, look, the way we kind of think about it as an investor, right? Like, so we are not necessarily time bound. We think of ourselves as very patient capital. We have companies on our portfolio where we've partnered with them for over 10 years, and we continue to be very supportive of them because they continue to do well, right? And, in fact, the way things go in early stage oftentimes is that it takes a little while to realize which of the companies are doing well because they're able to grow sustainably, right? So not the first, go from 1 million to 3 million to 6 million to 7 million, but what happens when they are in the 50 to 100 million range, right? Do they continue growing, right? And at that point, if they're continuing to grow and they're continuing to accrue value, we love still backing those companies and being patient, right? I think the question becomes, if one, growth is tapering off and it becomes no longer as exciting, or, which is a much more favorable situation, if you get that inbound offer that just is really compelling and that rewards you for future growth, right? And those are kind of the interesting ones. Those are the really fun stories, right? Where you start saying, look, we weren't planning on selling the company, right? But here's an offer that is very tempting and that really makes us think hard and also makes us think about what we could do as part of this new company, right? Are there things that, where today we are constrained for whatever reason that would be available to us, right? So I think these things come in different flavors. I think the saying is good companies are bought and not sold, right? So ideally, you would want to have people approach you, but for the most part, that doesn't happen magically, right? So sure, there's a couple of companies that are doing so well, they're about to go public, they file their prospectus, and then they're getting an acquisition offer last minute because it's just so obvious. But for the most part, I think the advice we give to our portfolio is get to know the potential partners and acquirers, right? Actually establish a relationship with them. Typically, it's individual people who make these acquisition decisions. It's not some amorphous organization. And people like to work with other people, right? So if you and I know each other and we have over time built a relationship and you've seen how I work, I've seen how you work, it's much more likely that we will come to some sort of partnership than if you see, a page of numbers and all of a sudden you have to get comfortable with something like that, right? It's the same thing that, by the way, holds for investors, where we try to meet founders much earlier than when they're fundraising because we want to establish a relationship. We are investing in people, right? And we love getting to know founders and being able to share a little bit about ourselves, right? So that it then feels a little bit more thoughtful and planned as opposed to, the ready, start, go sort of race where you all of a sudden, speed dating, met for the first time, 20 investors in a span of 4 weeks. You then, hit it off with one of them, but it's not quite the same as when you've known that investor maybe for a year or two, right?
Completely. Yeah. I mean, that's I'll wrap up with this kind of question, so the big piece is, we're looking at growth, we're looking at metrics, we're looking at presentation, but at the end of the day, investors, we're investing in the people. And there's a lot of factors, right? Humans are the most probably more complicated than the business itself, but I'd love to hear from you. Is there some kind of common, traits or something that you've seen among what stands out of high performers or the kind of the top performers of the entrepreneurs that you do invest in and see that, you continue on to invest in?
Oh, that's a great question. I wish there was a list. I really do. Right. I would say, look, so one, I think among our portfolio, if I looked at the companies that have overachieved expectations or underachieved them, people are by far the biggest difference, right? And that's what makes my job so exciting and then also sometimes so frustrating, right? Mm-hmm. And, a couple, I think, of characteristics that I have observed as being helpful with the caveat that this is a space where outliers confirm the rules. So it's going to be very easy to point to an example that is just the opposite for what I just said. And I'm very willing to admit that. And that's also what kind of makes this job interesting, right? But I think the ability to hire and, more importantly, retain people is critical, right? So, and we definitely look for that when we are speaking to entrepreneurs, right? We look at what people they've hired. We've looked at who it is that they're speaking to, and we speak to the management team, how they think about the company. And, we check things like Glassdoor and sort of all the usual reviews, right? Because fundamentally, that's what it's about, right? If you're a team of 50, 100 people and you want to grow to 500 people or 1,000 people, you're not going to be able to do it alone, right? And you need to be able to attract people and, more importantly, retain them, right? And the retention part is the much trickier part. And I think a lot of people focus on the acquiring part and they just hired someone, right? But the really tricky part is to say, how do you make someone successful in your organization, right? And how do you allow them to perform at their highest level, right? So I think that's probably, that's a really key part. I think customer obsession is another really important one, right? Which is to say, especially when it comes to B2B software, you're typically solving existing problems, right? And your number one job is to understand what exactly is that problem and what is the solution that customers are looking for, right? This is not the same as Steve Jobs telling consumers that they now need a phone without keys, and eventually he's right. For the most part, it's a much more feedback-driven process, right? And not to say that Apple is not, they are, but I think it's much more saying, do you focus on your customers? And have you then created this feedback loop between product, sales, and customer success that has an impact on your product roadmap, that you're building something that customers want and that you're prioritizing things in a way that aligns what customers want with your capabilities, with your revenue targets, right? And this prioritization, is really important. But it all starts by saying we're trying to solve a problem, right? And then the third one of that is to say, are you the right person to solve that problem, right? Do you have founder product fit, founder problem fit, whatever people call it, right? Why are you the person who is going to be best equipped to solve that problem, right? And I think there, I love coming out of these meetings and understanding some sort of differentiated insight that the person has, right? And really saying something, okay, some of what you said was obvious, and I got that even knowing nothing about it. But one of the things that you said and the perspective you had on it was just really intriguing, right? Mm. And that's kind of, I think, what typically stands out, right? Is that you know your domain so well, you've spoken to so many customers when you embarked on building this product, and you understood why the problem that is so big hasn't yet been solved or hasn't been solved successfully, right? Because the first question is, if the problem is so obvious, how come it hasn't been solved already 5 to 10 years ago, right?
Exactly.
And so I think that answer, requires a bit more thought a lot of times that is given. And it also talks a lot about differentiation and modes and all those buzzwords that people like to talk about.
Yeah, that makes sense. So customer obsessed, and then there's problem obsessed. And I love that, thinking of what differentiates it. Because I mean, people always think about credentials and maybe your background, your education, which, may be fitting, but there are people who, I think my opinion is if you're problem obsessed more so, I think you can, find things that even people with credentials wouldn't even be able to see, right? So,
100%. I think, look, I think credentials take on a very different meaning at that point, right? And I would say, the other thing, of course, by the time you arrive at sort of a Series B, it's no longer about ideas, it's about execution, right? So you want to have the foundational idea, but, we talked about it earlier in the conversation. At that point, the proof is in the pudding. Were you able, you might have had that great insight and you might have had, the will to pursue it, but have you been able to do it, right?
See the results. Yeah.
Yep.
Yeah, love it. So this has been great, Michael. Love it. This is awesome insights. Would love to shift gears and move towards the rapid fire personal questions. You ready for that?
Oh yeah, I am.
Yeah. Let's do it. All right. Michael? What's one activity you enjoy outside of work that gets you into a flow state?
I don't know about a flow state, but I wrestle, which is a really random one. And I know I'm supposed to say kite surfing or something like that, but
jiu-jitsu. It's wrestling. Awesome. That's an intense sport. So I think boxing and wrestling, I guess, are one of the most, taxing sports, right? Just for
it's taxing, and also it doesn't really leave room for your thoughts to wander. You've got to be in the moment, otherwise it doesn't end well.
And you're going to be in a lot of pain. Yeah. What's one piece of advice you wish you had known, and if you can go back, you would tell your younger self, say 20, 25-year-old self?
Yeah, that's always a good one. Abstracting from maybe myself, I would say taking more calculated risks and betting more on myself. I think, I've tended to err on the more conservative side. And I think in hindsight, I could have been a bit more courageous at certain points in my life, but that's easy to say now.
That was easy to say, but now you know the risks, right? It's always, trying to understand what it is. When you're younger, it just seems so much bigger, right? Yeah.
That's right. That's right.
Yeah. What are some of the biggest challenges you guys are currently facing, or yourself, to continue to grow 8 Road Ventures, your portfolio and the performance? Or is there anything that keeps you up at night these days?
Look, we practice what we preach, right? I mean, I said the importance of attracting and retaining talent is the number one. We reevaluate founders, and that applies to us as well, right? So I think for us, it's all about the team. We are not constantly hiring people. So for us, it's about really attracting the right individuals, but more importantly, setting them up for success at 8 Roads, right? And I think that's the number one priority, and where we invest quite a lot of time and resources to make sure that our team really has access to all of the best resources, mentors, and are able to become the best investors they can be.
Love it. It's an art.
Very poetic.
It's an art. I mean, that's what I've learned over the years. I mean, just investing, and like I said, it's humans behind it and understanding what you're behind this market. It's an art itself. So yeah, love it. Speaking of resources, what are some of the best, maybe 3 resources? It can be books, mentors, or people you follow in the space who've been most instrumental to your success over these last few years?
Yeah, look, that's a good question. So, I mean, I've been fortunate enough to be surrounded by some great people throughout my career. And, you've listed off some of the organizations I've been part of, all of which I think very highly of, and who have invested in me throughout, right? And I would say, as far as information sources, I am more of a reader than a listener. So some of the amazing podcasts out there, and yours, of course, as well, I'm better at consuming content and information in read form. And so Twitter has been really fun. Substack makes my life much easier. And so I just read a lot of stuff, and it's typically short form content. A lot of the books out there, I think, could be a blog with a bit of editing, but that might be a controversial opinion. We don't have to spend too much time on that.
I agree. Yeah, a lot of fluff that could be summarized. Yeah. What does Michael? You've done well with your career. You're doing well with your portfolio. What does success mean to you today? Whether that's personally, business, financial, life. There's no right answer.
Yeah, look, I think day to day, I feel very privileged to be a trusted advisor, and trusted is an important one here, to some great entrepreneurs. And whenever I feel that I've been able to help them on their scaling journey, I think that's tremendously satisfying. And of course, whenever I feel that I've failed in that, that's tremendously frustrating. But focusing on the positives, I think I really enjoy that, and I think that's probably what I would call a success, right? And personally, at this point, it's all about staying healthy.
I agree. Yeah, completely agree. Love it. It's all about being healthy. Yeah. This has been fantastic, Michael. I really enjoyed this episode and learning more about you and your company. Where can founders listening in get in touch with you, learn more about you or your company, or if they want to present a company they have? You said based in Europe or Israel. Any companies out there that want to get in touch? What's the best way to get in touch with you?
Yeah, look, so LinkedIn is probably the easiest one. You can also try me on Twitter, and otherwise, our website has a ton of information, and if I'm not the right person for you, I can pass you on to one of my colleagues in one of the other regions. But I think if anyone listening is part of an exciting company that's doing well and is contemplating a, let's say, Series B fundraise, I'd love to have a chat.
Okay, awesome. We'll add your LinkedIn and Twitter to the show notes as well as the website. If you guys want to reach out, make sure to say hi to Michael. Thanks again, Michael. Appreciate you joining today.
Accel, I appreciate it. Thank you.
Thank you. Thank you all for watching this episode and joining SaaS District today. Don't forget to like, subscribe, and hit the bell for future episodes where we interview top leaders in the SaaS industry. If you're a SaaS company looking to grow and unlock the true value of your business, get in touch with us at Horizon Capital, and myself or one of our consultants will provide a free assessment to help you get there and hit your goals. If you have any feedback or suggestions for this podcast, please comment down below and help us improve our content for you all. Thanks again, and see you on the next one.